Alright, today we're going to be looking at UnitedHealth Group Incorporated. It's a healthcare company, as you can probably guess by the name, operating two businesses via the Optum and the United Healthcare segments. A quick overview of the company structure. So as of just the Friday gone, it was trading at $290 a share with 907 million shares in issue, giving a market cap of around 264 billion, cash position of 32 billion, debt of 73 billion, resulting in enterprise value of around 300 billion. And so I guess the reason we're looking at the stock today is given the massive controversy around the company recently, I guess with politics, which we'll get onto in a bit later on. But as you can probably see via the recent stock price, the stock absolutely crashed a couple of days ago, going to around $250 a share, which from its peak of around 600 is nearly 50%, actually over 50% decline in the share price of the stock. So what does UNH actually do then? So as I've previously mentioned, it's a US-based healthcare giant operating two primary divisions via the United Healthcare segment and the Optum segment, with obviously the United Healthcare segment being its primary business and revenue driver. And essentially what United Healthcare are is a middleman service or insurance company, bringing together individuals, aka people who actually need healthcare services, and then the people who provide healthcare, doctors and hospitals. The Optum segment is a bit more interesting. So it's actually a tech-enabled health service arm of the company, where they offer pharmacy benefit management, healthcare data analytics and care delivery. And then breaking down how both segments then make their money. So as previously mentioned, United Healthcare would earn revenue via insurance premiums, either paid by policyholders, so individuals, or government agencies, as I previously mentioned, things like Medicare and Medicaid. Whereas Optum earns their money via pharmacy services, so negotiating drug prices, providing health IT and analytics data, and in care delivery. And a good thing to mention with Optum is they're actually very profitable. So in 2024, they had 48% operating margins, which is by far the higher margin segment, and it's also the faster growing segment out of the two as well. So key cost drivers for the business, the three primary ones with medical costs, technology and admin, and regulatory compliance, with obviously, as you'd expect, medical costs being the primary one, which is when UNH pays out claims to hospitals or paying for drugs and treatments. And it's what drives their primary KPI throughout the whole sector, actually. The most important KPI, which is medical loss ratio, which we'll get onto in the KPI analysis. Looking at the industry overview then, as aforementioned also, the US healthcare sector is absolutely massive, right? So as of recently, it was worth $4.5 trillion. It's something that the government's, even on both on Democratic and Republican side, are actually trying to cut down on, as they kind of see versus other countries just how much of a behemoth this sector has become. And as I've kind of mentioned also, the way it's broken down is you have a lot of insurance companies, so individuals don't actually usually pay for their medical care. I mean, sometimes they might do, and they usually go into debt or go bankrupt doing so. But a lot of the times it's a company like UnitedHealth Group who are the insurance providers. They pay for the care to the hospitals and doctors or the pharma companies, which is also another good thing to mention, is UnitedHealth Group aren't actually a pharmaceutical company. They are just an insurance company. Some trends in the sector then. As we all know, with the most developed nations, there's an aging population, which will mean more healthcare going forward. And then the rise of chronic illness via unhealthy lifestyles that we're also seeing in developed countries, via food and lack of exercise. And then also demand for cost control and efficiency, which is more a comment on the Optum segment. In terms of competitive positioning then in the sector, UNH is by far the largest healthcare company in the US by both revenue and market cap, which we'll get onto in the sector overview. But they're the number one health insurer in America, and also the number one pharmacy benefit management via the Optum segment. And they also then have a huge data and tech moat via Optum Insight. Also listed some competitors here. So you've got CVS, Cigna, Elevance Health, and Humana, with CVS and Elevance being more diversified. But then I think it's called Aetna, I can never pronounce it, and Anthem being the insurance segments for both companies. Looking at the future outlook then, so we can look at the tailwinds and headwinds. There's a couple decent tailwinds that we've not mentioned, which is the growing demand in Medicare Advantage, which is obviously the senior plans, and then expansion of the Optum Health clinics and services. Whereas with the headwinds, there's quite a few, and it's, I guess, what kind of explains, the over 50% drawdown in the stock price. So we have government scrutiny over industry consolidation and pricing power, rising medical costs from inflation and labour shortages in care staff, and then the more relevant headwinds coming from both the, as I said, Democratic and Republican side, which is they're trying to rein in insurer profits. And then specifically, as of the last couple of weeks, we have the new Trump and RFK proposal to reduce Medicaid coverage via new legislation and the new government policies as well. And then that kind of coincided with the Medicare frauding investigation by the Wall Street Journal. We won't go into final thoughts because we want to look at more of the other tabs, but let's move on. So as always, kind of focusing on the more key and relevant points in both the income statement and balance sheet, and also the cash flow statement actually. As always, we're trying to trade the stock. We're not really investing for the long term with these analysis, so we don't need to look really too much in detail, just looking at the key items. So you can really see the massive increase in the revenue growth over the last few years, which again kind of coincides with the fact of why both Republicans and Democrats are trying to cut down on companies like UnitedHealth Group, given the massive financial success they've recently been experiencing. Operating income has increased massively as well. EBITDA's been really strong, although net income has been quite flat and if not decreasing, which is quite interesting to see. I think this is also linked to the cash from investing. So you can see cash from investing has been increasing significantly, and I think this is the investments into the Optum segment of the business. So the net income, which again kind of explains why the operating income and the operating profitability of the company has increased substantially, while the overall net income has kind of floundered, is because a lot of that is going into capex and investments into the Optum segment. We also seen a bit of share buybacks, so from 942 million to 920 million to now, as of recently, 907 million. And then the EPS again has kind of floundered and kind of stayed flat, given again the high investments. The overall balance sheet and the financial position and health of the company looks okay. So the current assets have nearly doubled, but then so has total debt going from around 40 billion to 80 billion. So it's kind of in line, but yeah, not ideal. But again, we'll go on to that in the sector overview now. So in the sector overview, you can kind of see more clearly the financial picture versus competitors. Usually I go quite in depth into this analysis. I usually really like looking at the sector comparisons and the kind of picture, although for UnitedHealth Group it's not actually as relevant or important, given the fact that they're just so much larger than everyone else from both a revenue and market cap perspective. The only real competitor you could argue is CVS, although as I've said, they're more diversified, so they do have an insurance arm, but then they also provide pharmacy services, and they're also just a kind of a pharmacy store, right? So they're much more diversified, so a lot of that revenue isn't actually related to the insurance sector. Whereas for UnitedHealth Group, that's primarily where most of their business comes from. Breaking down then the key metrics that I like to look at then. So forward EV to sales, forward PE ratio. The forward EV to sales, you can kind of see UnitedHealth Group are trading at a significant premium to the rest of the sector. The only other one being Alignment Healthcare, but then they're basically a very small cap, so again, you can kind of exclude them out. They're also not a direct competitor within the insurance sector. So again, they're not really a like-for-like comparison. But compared to the other insurance companies, UnitedHealth Group have a significant premium towards their revenue. I think that's kind of justified, to be honest, because on that revenue, they generate the most profit. So you can see the net profit margins here. Again, by far the highest in the sector at 5.4% versus everyone else who's around 2-3%. The forward PE is roughly in line with the sector average. I think this is fair, especially it's actually kind of slightly under, to be honest, given the fact that they have one of the worst earnings growth year over year projected at negative 14%, and then revenue growth pretty much in line with the sector average. So overall, I think the picture is quite mixed. Both the forward multiples I think are justified, and again, you can see just from an eye perspective with the color coding blocks that I do, a bit of red, a bit of green. It's kind of a mixed bag, to be honest. So we'll skip the fair value and price target and go to KPI analysis quickly. I don't want to spend too long on this segment, but but I guess the main KPIs I'd like to pretty much talk about would be, as I mentioned previously, the medical loss ratio, which I think is the most important KPI, and this essentially looks at the premium revenue spent on clinical services and quality improvements. But it's essentially at the gross profit margins of the sector, and you kind of see it creeping up from around 82% to 85% in the last couple of years, which is not great. But if you compare it to a lot of their peers, like Humana, Centene, Elevance, and even CVS slightly now, they're still below their peers, which is a good sign. But yes, overall for the whole healthcare sector and industry, it's all creeping up, which is probably an indication that costs are rising and eating into profits. Membership growth has been quite steady, so 2% year over year, but it's also maybe an indication that the market is kind of saturating and kind of plateauing now. We kind of touched on medical costs, so we'll skip past that. So Net Promoter Score is quite an interesting one. So it actually looks at customer satisfaction and loyalty. And when you look at those scores, it's significantly below the industry average, which is quite concerning. And then again, some regulatory fines and legal issue comments, which we've also mentioned already. But yeah, the overall KPI picture isn't great. Again, with my color coding, you kind of get a quick eye test on seeing if it's positive or negative, and there's far more red than green, which again isn't ideal. As always, I do a SWOT analysis then, looking at the strengths, weaknesses, opportunities, and threats. I'll either let you guys pause it and read that, or again, grab the document below in the description, and you can kind of go through it in your own time. Some Wall Street insights I always find really helpful and interesting. And then again, there's some technical analysis and some comments on the Q1. Alright then, to conclude, as always, we look at the fair value price target for the company. If you've not watched the previous videos, I usually like valuing companies on their top line, which is revenue, and then their bottom line, which is their earnings. Usually, as long as the company is profitable. Obviously, if it's a high growth tech company, then we usually just focus on the top line revenue and forward sales. So as you can see on this section here, I give my comment and kind of justification for the valuation multiples. And then I also factor in the market valuation multiples, which is basically the prior year multiples the company had. Kind of then focusing more on the reasonable valuation multiples then. So we factor in the historical context. So in the last 10-year average, the healthcare sector has seen a PE of around 16 to 17 and a forward sales of around 1. And then specifically the insurance segment of the healthcare sector has around a 15 to 20 forward PE, but then a much lower price of sales of around 0.5 to 0.7, which we'll come on to. The current multiples of the companies here. So you can see everyone has a forward EV to sales of below 1, and then a PE between 10 to 15. And then we look at UNH's position, which again we've already mentioned, but they're a very large and diversified health insurer, steady growth, and historically trade at a premium given their profitability versus competitors. We also then, as always, factor in some risk factors, and I think this is the most significant impact on the valuation multiple this time around. Given, again, like I said, the political pressures with both RFK Jr. and Trump campaigns targeting price transparency, consolidation, and then divestiture of the vertical integrated model, basically trying to crack down on fraud in the in the sector. And all these risks essentially kind of suppress valuation. Despite the long-term fundamentals of the sector, we're likely to see a crackdown in profits and potential revenue growth. Nonetheless, though, UNH have strong growth drivers and massive scale, but I think it's fair to give a conservative multiple given these political and regulatory overhangs. So because of that, then I'm going to give a PE ratio of around 12.5. This is factoring the decline in earnings growth, and it's in line roughly with the sector average, slightly under, and I think that's fair, again, given the above average earnings decline versus competitors. Sales multiple then, I'm going to give them a premium versus the rest of the sector. So like I said, no one really has more than a 0.5, and historically it's around between 0.5 and 0.7. So I think 0.6, bang in the middle of that, given a decent premium currently to competitors. And the reason for this, as I've kind of mentioned also, is due to the strong net profit margins, which, to be fair, I do see coming down, again, given the crackdowns, but I still see them maintaining, I don't know, maybe a 4% net profit margin, which, again, would still be by far the strongest in the sector. So focusing on the reasonable fair value price targets, funny enough, a 12.5 PE and a 0.6 sales multiple actually gives pretty much exactly the same fair value price target of $298 a share. You can again kind of factor in the market valuation multiples. So last year the company had a PE ratio of 32 based on its $400 billion of revenue, trading at $500 a share, which is very, very rich, even historically. Like I said, we don't usually see it creep above 20. You can kind of see here the previous years are 24, 22, I think is more in line. I think the market got a bit ahead of itself in 24, given the fact that EPS drastically reduced, but then they kind of maintain the same stock price. I think that was a clear sign that the stock probably should have come down from that point. And so the fact that it didn't kind of gave that inflated PE ratio. And then looking at the prior year sales multiple, usually as you can kind of see, in 22 is 1.5. It was slowly creeping down to 1.16. But yeah, roughly, I think a sales multiple of around 1 in a healthy growing environment, I think is fair. But I think you now need to factor in a lot of the risk factors currently facing the stock and a lot of the fraud concerns. So I think 0.6 is relevant and fair. Cool, so I think we'll wrap it up there. As always, if you want the document for yourself, you can grab it in the description. Any comments or queries, just drop them down below and I'll try to get to them. But yeah, until next time.